Hello, everyone. My name is Adam Williams, and you are listening to another episode of Retail Redeveloped. Now, we are taking a little bit of a different approach with today's episode. We're stepping a little bit outside of the typical retail nerd arena that we play in. I thought in an interesting time like this, in the middle of COVID, we would take a more of a global view of what is going on in capital markets and business at large. And I'm so happy to be joined by Michael Gayed. He's the portfolio manager at Toroso Asset Management, award-winning author, publisher of the League Lag Report, which is how I originally came across his work. Michael, thank you so much for joining me today.
Yeah, it's my pleasure.
So before we get started and I start kind of dialing in things on the retail side, would you do us a favor and just tell us a little bit about who you are, how you got to sit in the seat that you're in, and a little bit about the why behind what you do?
Yeah, sure. So just by way of some background, for the pretty much most of my life I've been involved in investing in markets, going back to literally being at a dinner table, hearing my mother and father talking about what the stock market was doing at any moment in time. Given that my father had his own investment firm in the 90s and kind of getting information via osmosis from that. Been a part of the last 8-9 years, built a bit of a name in the industry, had a period in my life when I was on CNBC and Bloomberg fairly regularly, was one of MarketWatch.com's top writers for a few years, built a fairly large social media following along the way, about 130,000 Twitter followers, 30,000 LinkedIn first connections, and co-authored 4 white papers that won 4 separate awards, 2 from the Chartered Market Technicians Association and 2 from the National Association of Active Investment Managers. And I traveled the country. I did presentations, been to 47 states, to thousands of individuals, advisors on the findings of those papers. And all of those papers, in some way, shape, or form, relate to a mutual fund that I launched at the end of 2012, which thankfully is having a nice run here, but uses many of those concepts in the papers, in the management of the risk-on and risk-off rotations. A lot of the analysis and content that I do is meant to give voice to math. I have learned over time that numbers are boring. But if you want to get people interested, you've got to create a story around the numbers to provide some context and hopefully make it easier to understand. And I think in an environment like we're in now, I'd argue that paying attention to the numbers and somebody who can properly communicate those numbers probably matters more than before, just given the severe anxiety most people have over the economy and sort of the state of business now.
So let's talk about what you just mentioned, kind of the panic and the reactions in the market. Being a dullard when it comes to the stock market is not my main business. Commercial real estate, asset management, retail, that's my forte. Help me understand how the stock market is having large rallies in the face of kind of unprecedented or near unprecedented unemployment numbers. Like how would you kind of distill that down to somebody like me and explain to me the why behind it?
I think we have to kind of go back and see how this played out first and foremost, right? When the headlines started hitting around COVID, around coronavirus, I was noticing before the stock market was really reacting that the things that were trending on Netflix where movies like Pandemic, Outbreak, you started hearing at the periphery stories about how toilet paper was selling out, how you couldn't get soap. So before the stock market really reacted very violently, there was almost an earlier reaction than most people, I think, realized at the time, that there was a degree of paranoia starting to kick in, that maybe this is one of those end-of-the-world Hollywood story type of situations. And once you have some part of the crowd start to react in anticipation of that, others start to notice, and that creates sort of a self-fulfilling prophecy of hoarding and of fear. The market then started obviously acting more aggressively as you started seeing some of these cancellations on major events, on sporting events. started collapsing. It looked like it was the beginning of a depression, and there was tremendous misinformation, uncertainty. And as the decline was happening, my fund was fully exposed to treasuries, avoiding the collapse, thankfully. But as the decline was happening, I was interviewed on a few major media outlets, and I was trying to be a voice of reason, basically arguing that, look, quote unquote, they, meaning the Fed, the fiscal side, the government, will not allow for this to keep collapsing the way it was, because it was my deep belief back then that if you were to keep collapsing on the stock market, that would probably be a much deeper, much more serious situation than a pandemic. It would be a capitalism reset. And I say that not from a hyperbole standpoint, but when you take a look at the conditions that we're in and the context under which we're living, never have you had so much global debt in the system. Never have you had so much reliance on the stock market for wealth. Never have you had interest rates this low entering a recession/depressionary environment, which meant that the policymakers had to literally, I'd argue, go to the extreme of almost enacting socialist policies, meaning monetize and lend to state governments, monetize and lend to corporations directly, try to do these kind of socialist policies, to save capitalism. And that's largely why the markets had such an enormous rebound in the face of what looks like a depression in terms of unemployment numbers. Now, when you dig deeper into the underlying data, it is actually not as bad as it seems to be, meaning that aggregate spending has not really collapsed as much as unemployment has risen. And I think a large part of that has to do, obviously, with the fact that a lot of the jobs that have been, furloughed or lost, obviously, are more on the lower income side of the equation. And in some cases, the unemployment checks combined with the fiscal stimulus checks in aggregate are actually more than what some of these individuals were making before they got laid off or furloughed. So when you look at kind of things from an aggregate perspective, it's not as simple as to say unemployment's at, roughly 20%. And, why is it that the stock market's, holding up and doing well? When you look at the spending patterns here, it's actually not as dire as you might think, largely because of that, I'd argue, manipulation by, again, quote unquote, they, the Fed and government, to prevent this from cratering. Now, I do suspect that this is not over, meaning that, you have this sort of traditional bear markets and declines in equities. You tend to see very major moves up and down both ways until, the fullness of time has resolved all the issues to begin with. So I don't think it's sort of, safe sailing, so to speak. But I don't think anybody should be that surprised that, policymakers will manipulate this to the point of it being an enormous disconnect from the facts on the ground.
So let me ask you this. You mentioned that you don't think this is over. I honestly am worried about what happens in the fall when everybody kind of starts to forget about where we're at today. In your opinion, can the Fed keep bailing the way they're bailing now? You mentioned that the rates are already at zero. They're already pumping trillions into the economy. The debt before we did that was already staggering. They don't have that many levers left to pull. What happens? Can that stop? In your opinion, as somebody that follows this on a minute by minute basis?
Yeah, look, I tell people, if anything, the Fed has proven that they're very creative at preventing creative destruction, right? Meaning that they will find ways to the point of, doing things that are arguably not capitalist and not in their legal authority to try to prevent an economic collapse. So as much as I hear the argument all the time, they don't have bullets. They'll if they need to 3D print bullets, they will, because they have the ability to just print dollars out of nowhere. That's not to say that they're going to be successful, though. This is something that I always challenge investors when they think about the Fed. You always hear this mantra: "Don't fight the Fed. Don't fight the Fed." Well, that's true when markets are rallying, but the Fed is still doing things when markets are collapsing, and markets still collapse even though the Fed is still doing things. Even this year, markets were cratering, and the Fed was just upping the ante every single day with more and more policy response and more numbers, whether it was on quantitative easing or lending facilities, that at some point they were destined to get some combination that would work or some bazooka that was large enough. But you still could have fought the Fed throughout the entire decline and been okay, avoiding the collapse to begin with. So I think, look, the real problem here, and I think it also does relate, by the way, to retail. I think the big problem here is coming out of this. First of all, you couldn't pay off the global debt or the national debt or the domestic, the debt of consumers before this. You couldn't pay it off. You couldn't grow your way out of this tremendous debt load that we have in the system. Coming out of this, God knows how bad it's going to look. And the end result of what's happened so far this year with this pandemic is that in their efforts to save the system, they're actually dramatically widening the wealth gap. I'm sorry, but a $1,200 check from the government pales in comparison to the 30% rise off of the lows for asset holders, which is really concentrated among just a small portion and really among wealthier individuals, as opposed to the man on the street, which is nowhere near benefiting to the same extent, right? That, I think, has a lot of very big implications on a lot of industries, not just retail, but on sort of this bifurcation of goods between premium and low end and sort of the way you segment the selling of services and products. But, it is, I think, just going to be a challenging environment. And keep in mind, everyone always says, listen, we entered this pandemic with an extremely strong economy. The balance sheets were great, all this. Okay, that's partially true, but you also entered the pandemic with an enormous debt load that was only going up and accelerating. Now you just added more fuel to that fire. That to me is really the sort of big question mark. And, especially as these, municipal states are like New York, for example, are in deep financial holes because of the pandemic. To me, that means only one thing in the future, which is at some point they're going to have to get that money back either from the Fed or from taxes. And, I think in particular real estate taxes. And that's a whole another kind of interesting sort of scenario to play through, I think.
Well, and speaking of New York City, I mean, I'm calling you from Charlotte, North Carolina, and we didn't have nearly the impact as New York City, to say the least. I mean, what do you think? I mean, New York City's under a tremendous debt load. Everybody that I know, all the investors and people that I live in New York are very shaken. New York City, the public transit, obviously, is something that people are probably going to be a little leery of using in the same way they did. And then you talk about their ability to raise taxes from a real estate perspective. Do you think New York City real estate looks the same way in a year that it looks now? I mean, it just makes me very, very nervous to think about how New York City rebounds in the face of something like this with so much uncertainty ahead and being kind of the epicenter of something that we're still living through.
Yeah, so look, I think there's a few things, right? And history has shown, whether it's, comes to the United States or even, European history, right, that you have these periods that can last for, many, many years where there are these migrations, right, away from rural into urban or from urban to rural. And I suspect it's going to be, that type of a scenario, meaning it's not just a story of New York City. I think that there at the margin are going to be enough people who are going to say, you know what, this is such a jarring experience and scary thing that you'll probably see people moving out of denser areas and, probably spreading out to be more socially distant. I have an advisor in my mutual fund who's in Nebraska. And I asked him, I said, how are cases there? He said, there's maybe 100 people in my town and nobody's really worried. Well, of course, because they're naturally socially distant, right? Because there's not a dense area in other
not a big international airport probably in his town.
Right. Well, exactly right. So when you think about it like that, I think there is going to be a suppression and sort of a normalization of some of these, very high real estate prices in major, cities like New York relative to other cities and other sort of more rural areas. That migration is going to, I think, normalize things a bit. But so I would agree with the sentiment that New York real estate is going to be hard. And remember, I think people are, especially wealthy real estate investors, probably recognize that that's coming. Right? You have to assume that major property owners are going to, aside from the fact that a lot of retail shops are not going to reopen, some empty areas for a while. There's got to be an expectation that at some point, the piper's got to get paid, and that means that their taxes are going to have to go up. So I think there is going to be a redistribution of sort of where property is being held, so it's less concentrated.
Do you think that is a migration from maybe what we would consider like a tier 1 city, like a New York City, to a tier 3 city like a Charlotte? Or do you think people in Charlotte are going to go an hour and 15 minutes away where they might have only lived 20 minutes away just to really disperse, like that level of a dispersion? Or do you think it's just going to kind of relieve the pressure off of the Chicago, New York, LA, San Fran, Houston, like the absolute top, most dense cities?
Yeah, probably more the latter. And the only reason I'm saying that is, the media has been so, and listen, I live in New York, right? So the media has been so focused on New York as sort of the look at how bad it is. But from everything I've seen, the people I talk to all over the country, it's scary from what they're seeing, but it's not like there's real panic. Life is still going on. People are as stores are kind of starting to open up, and people are wearing masks, people not wearing masks, but life is continuing. So I don't think it's as jarring for everybody else, obviously, as it is for where I am. But having said that, you never know, right? I mean, all that's also contingent upon, could you see another wave higher of cases on reopening? Looks like Texas, for example, is reopening and starting to see some cases increase, and you'd expect that, right? Because that's going to happen. If you get a vaccine, very quickly, and you don't have any kind of mutations, and it gets the population gets inoculated, you know what? People have a short-term memory, and they might just stay where they are.
Yeah, but we're talking about best case scenario there. I mean, obviously there was some news yesterday. Right. It was very exciting, but just hard to imagine this is all going to be over in the blink of an eye. I want to go back to something you mentioned earlier about the wage gap divide, the potential for it stretching out, and the furlough money running out. I mean, I've seen stats that say that the retail supports like 1 in 4, 1 in 5 jobs in the country. It's this massive number, and obviously all those people are absolutely crushed right now. I mean, what do you see happening when that furlough money runs out, when the unemployment runs out? You've got some people that are making more now, not working, than when they were waiting tables. And how do you see that national going back to work playing out on the people that are on that lower end of the bracket, the hourly workers, the people that are making $30,000 a year, not $300,000 a year? Right. I mean, how do you see that playing out?
Yeah, I mean, you're already starting to see sort of a redistribution, another right word, sort of a repositioning by a lot of people, right? I mean, Walmart announced tremendous hiring. They've been hiring, very actively. Amazon's been hiring. Instacart has been hiring. I mean, you're seeing shifts towards, those types of situations, especially where there's delivery. So I think, you're going to have less waiters and bartenders and probably more delivery people in general, right? So that shift, I think, is probably what's going to come. And the other part of this also is, I'm a cynic in the sense that it's an election year. I can promise you none of this money is going to run out. They will find a way to keep it going. The problem with this is that everyone is pot committed, meaning that it's not like you can say, well, we're going to protect incomes up until June and people are still unemployed and, good luck, you're on your own. It's just not going to happen. Even though they may jawbone it that way, it's just not going to happen. So, once you start these kind of policies, it's very, very, very hard to pull them back. Which has its own problems longer term, but I wouldn't be as worried about sort of that side of things. The bigger issue is going to be how are you going to motivate people coming out of this to go back to work, right? So that you can counter their fears about getting, COVID against sort of the reality that, they also just can't be taking handouts, forever. That's going to be the real kind of interesting question mark. How do you change behavior, to incentivize people to get back to work instead of just expect that the government will bail you out?
So I want to go back to this notion of increasing property taxes. Let's take a mall, for example. Let's take a Simon Property Group, a massive multi-billion dollar company. They have malls that probably by themselves would be valued as a $1 billion asset. Their top tier malls, South Park Mall in Charlotte, Phipps in Atlanta. I mean, they have, or you could take Brookfield or Related, any of these just behemoth, monolithic kind of real estate retail empires that have been built. How does it play out when, we do a tremendous amount of work based on occupancy costs, right? Like that's how we kind of back into rents many times, right? So you have a store that's doing, let's just pick a number, $3 million a year, $4 million a year. They want to pay us 7-8% of their rent as occupancy cost, and they went from doing $3 or $4 million a year projections to $900,000 to $1.5 million. Everybody is mass renegotiating rents. Simon's asset went from $1 billion to $650 million, and then they're pushing back on property taxes. Like how does this kind of systemic just reset? How do you see that playing out? Who's going to be left? I mean, can that get kicked up to the Fed? I mean, what does this look like in 60, 90, or more than that? What does this look like in 6 months or a year when there's been a massive kind of culling of this massive industry?
I mean, I'm happy to let you know in 3 years.
Wait a minute! I thought you had a crystal ball. That's the only reason we're talking.
No. It's funny. I always tell people that no amount of intelligence or research increases the clarity of one's crystal ball, which is why I'm such a big fan of conditions and try to identify that as opposed to predictions. Right now to that point, I think it's very hard to try to really know. Yes, there is clearly an apocalyptic scenario, which is the landlords and the owners of mall properties, for example, they just say, okay, just we can't pay taxes. You want to take the property off our hands, take the property off our hands, and there's kind of a lot of legal wranglings that happen from that. But against that, I am fairly confident that, again, because it's hard to take politics out of this, that there would be these attempts on a local level to try to keep some of these situations at play and not have these kind of defaults, so that you don't have this scenario of sort of the empty malls in neighborhoods. And seriously, I hadn't thought about this until now, but you're probably familiar with the broken window theory, right? That if you have a broken window in a neighborhood and it stays that way, it actually degrades the neighborhood. And
right. You start with one, you have 10, then you have 50. Yep.
Right. So now let's apply that to that line of thinking. If you're going to have just these kind of ghost retail locations, that's going to have very serious impacts on neighborhoods where those stores, where those malls are. I find that very politically hard to accept. So, and I'm sure these politicians know and are aware of this, right? So that's why I'm saying there's no way to know. I don't know if it's as apocalyptic as it's being made out to be, because I think there's enough of a will to try to counter those types of scenarios. And then let's face it, the when you're in environments like this, the public likes to focus on an individual or group of individuals to say you're the reason at the end of the day why things are this bad. We saw Congress wants to get Bezos in there to question him on things, Bezos from Amazon, right? So, and Amazon's always been a boogeyman in the retail and spending and mall space. So again, it's very hard to know. I go back to this point. Nobody predicts the future. The negative narrative in apocalypse makes sense, but it's not a guarantee by any means. So I think it's hard to sort of, be overly bearish. And even if the bear case does play out, listen, there are always going to be winners. There's always going to be consolidation. There's always going to be cheap assets that are at distressed levels that somebody will benefit off of, and in the fullness of time, probably make money off.
Yeah, there's no question. I know a lot of distressed asset buyers that are sitting around licking their chops, just waiting for that maybe not apocalyptic scenario to play out, but a scenario that at least lends itself to that environment. What else are you seeing on a macro level that has your attention that could perhaps distill down into the retail world? I mean, what else has kind of arrested your attention that you're focusing on right now?
Yeah, so look, I think and I tweeted about this the other day. There's nothing quite like being reminded of one's mortality to make people want to spend faster, right? Or have more babies, or to live life faster, right? We saw that with that's really what created the baby boomer generation to begin with, right? Coming out of a war, right? So obviously this is not as bad as that in terms of deaths, but the reality is I think this is coming out of this. Yes, I do believe the argument that you're going to see a tremendous amount of pent up demand, as these openings take place, and especially obviously when a vaccine is there, which could be very inflationary, which sounds crazy to think through when everything around us looks like deflation, staying at home, nobody spending now, everyone ordering things, but human beings are social beasts. I mean, at some point, when things really kind of go back to some degree of normalcy, and I think that it's going to happen, you're going to see, I think inflationary pressures rise pretty meaningfully. What that means for the consumer and for the retail space is you could see an outsized amount of revenue whenever that occurs. Again, going back to people just wanting to spend and going out. Amazon is not going to be the winner forever. And I know that's not a popular opinion, but it's an opinion, by the way, the stock market itself also thinks. When you look at the performance of Amazon stock relative to a broad-based retailer ETF, XRT, just sort of a proxy for retail stocks, Amazon and XRT have performed roughly in line for the last month and a half, 2 months. So this notion that you're going to see these kind of widespread defaults and that people are not going to spend, I don't think is really going to play out as simplistically as I think what you tend to hear in the media. And if you have that inflation, the thing with inflation is that inflation tends to self-perpetuate, because at the moment that you believe prices are going to keep going up, you start spending more, which causes prices to go up, which then causes more people to spend more, so on and so forth. Same thing with deflation too, right? If you keep expecting lower and lower prices, you're going to wait because you have lower prices, and that kind of becomes a self-fulfilling prophecy there too. I think it is underestimated how the consumer spending power of this inflation-deflation fight may end up shocking, the bond market and actually resulting in higher prices, not lower prices.
Yeah, I've heard that referred to as revenge shopping, which I thought was a really, really well put term, because I can tell you, as soon as my neighborhood haunts open back up, I might not do another dirty dish for a couple weeks, because I'm kind of over it. I wasn't much of a cook before this started, and I've been kind of forced into duty, and I'm ready to go out and spend some money when it comes to things like that. So getting back into your space, how do you counsel your investors to kind of weather these uncertain times, make smart decisions in extremely volatile situations? Like what is your go-to? And maybe this is completely different than past situations of volatility, but how do you walk people through that and make them understand kind of your point of view, or has your point of view changed?
Yeah, no, it's a good question. So, I mean, I always advocate this idea again that nobody can predict the future, and what that means is that you've got to be diversified. Now, where I have issues is where the way people view diversification. They tend to think it's having a bunch of stocks or having a bunch of ETFs or having a stock bond mix. And the problem with that historically, I used to always use this kind of thought experiment with advisors when I was on the road pitching day tech rotation mutual funds. Yeah, I'd say to them, listen, talk to me about your portfolio, how are you positioning your clients? And then I'd say to the advisor, so tell me, what portion of your portfolio do you hate? I don't hate any portion of my portfolio. I'm well diversified. Well, actually, if you don't hate a portion of your portfolio, you by definition are not well diversified. Why? Because if you hate a portion of your portfolio, it probably means it's not doing well when everything else is doing well, which is exactly what you want, in a diversified portfolio. You don't want everything to be doing well at the same time, because it means everything reacts the same way, both up and down. So what I advocate to anybody investing in general is you have to view your assets not from the standpoint of markets going up or markets going down, but rather how do you have as much exposure to as many different unknowable futures as possible. What that means is stocks, bonds, things like gold, things like my own fund, things that kind of march to their own beat, maybe Bitcoin, maybe collectibles, right? Have a mix of things that are not as reliant on the S&P 500, because that's the only way to really sort of have a more robust return stream over time. And that inherently means, by the way, you're not going to always be doing well. You'll simply always have exposure to a scenario that could do well, right? It's more of a mindset for me than anything else. And I think if anything, with this, the market decline this year, I think has reminded people that, just because you have a lot of positions in your portfolio doesn't mean you can't lose money, when the proverbial, stuff hits the fan, so to speak.
You feel free to curse. You can say whatever you want.
Okay.
There's no children.
Well, fuck it, man. When the shit hits the fan, all right? That's I really do mean that, though. It's a mindset, and I think it's something that really, really is important. People always say, listen, the future is more uncertain now than ever before. It's complete bullshit. The future was always uncertain.
Right. We just didn't quite know. Yeah. Now it's hitting you in the face. Well, Michael, this has been so much fun to kind of get out of my comfort zone and talk about things that I'm not on the front lines about. Do me a favor. Could you tell people how they can connect with you? How they can read more about what you're doing, how they can kind of follow you on a more real-time basis.
Yeah, I mean, the best way on a real-time basis is to follow my Twitter account at Lead Lag Reports, or just kind of look me up on Google. You'll find the website of my investment advisory firm that I work under, as well as sort of all the other research that I've put out over the years. So, but at Lead Lag Report on Twitter is definitely, I think, the easiest and hopefully most appropriate real-time way to track my thoughts.
All right, real quick knee-jerk question to finish things off. How do you see the market recouping after the stay-at-home orders are lifted? And what do you think it takes, either a best-case scenario or a worst-case scenario, to get our economy back to where we're not looking at it every 500 times a day?
Yeah, I mean, listen. I mean, I think the nightlife industry is going to be hard for a while, and you're not going to really go back to full on, flights to the same extent or restaurants to the same extent. The fact that they're even talking about removing middle seats in airplanes, that I think at the end of the day is going to actually result in higher prices. Just the fact that you're talking about restaurants only having 25% of the dining space they used to have because you got to space out tables, all that has very serious ramifications on profitability. And I think that it is going to be a different environment and different world until there is a vaccine, and we're mass inoculated. Look, every generation has something serious to have to deal with. We had 9/11 and obviously very serious, kind of life-defining moment for a generation. This is clearly another one, and certainly for the economy is the case. I think the one thing you can kind of say about how we come out of it is it's going to look different, but we will come out of it. And it's never paid to be pessimistic on the human race.
I completely agree with that. And to your point of the wage gap and this potentially leading to things like that, I mean, think about if, the best restaurants in town, or even not even the best, I'm not talking about Danielle or Le Cirque or something like that, but just good restaurants, if they can only seat half as many people, obviously if you've ever read an economics book, the prices are going to go up. The people that can't afford it are going to continue to eat the same veal that they liked 6 months ago, and a lot of other people are going to be pushed out of that equation, and that's going to be a scary thing.
Right. Yeah, I agree with that.
All right, Michael, thank you so much for joining us. Really enjoyed it. Really enjoying you pushing me out of my comfort zone today, and I just want to take a second and acknowledge you and say thank you for you taking a few minutes out of your busy schedule.
Yeah, no, I appreciate it. Thank you.